In the early 1600s, tulips were extremely popular and price went up dramatically. So to haste the risk in case of a bad harvest, the buyer began to buy call option and farmer began to protect their profit with put option. So at first, the trading of options seemed to be normal, but unfortunately, due to a recession in 1638, especially when the option market at that time was entirely unregulated, so it caused many people to lose everything. So the New York Stock Exchange market were open lately in 1791, but the Chicago Board Option Exchange (CBOE) wasn't created until 1968. The emergence of the computerized trading system and the internet has created a far more viable and liquid option market than ever before. And then we can see more coming in several new players such as Boston Stock Exchange, International Security Exchange, NASDAQ, and New York Stock Exchange. Um, Nowadays, there are billion option contracts traded every day, and the market just continue to grow. Now we can take a look what is an option. An option gives you the right, but not the obligation to either buy, which you call, or sell, which you put, an access sometime in the future at a predetermined price. And depending on the time to exercise, we have a European option, which only asks the expiration date, while the American style will give you the right to exercise at any time. And a call option is said to be in the money when we have a right to buy a stock price less than the market price. Likewise, if a put option in the money, it will allow you to sell at a strike price higher than the current market price. So the option premium is what you pay upfront and it's not refundable no matter if being exercised or not. And the premium is quoted on a per share basis, which means that you need to pay $20 for an option with a premium of 20 cents because each option contract holds 100 shares. And the premium determined by the intrinsic value, which is the difference between the current and the strike price. The time value, which is the length of time until the option expires, and volatility, which is the stock price fluctuation. So the time value will decay over time, and generally, an option will lose one-third of its value during the first half of its life and two-thirds during the second half. And due to a number of risk factors influencing the price, the option pricing presents some unique challenges in figuring out how much they're worth. So that's why people turn to option pricing theory to calculate the theoretical value of an option. The book mentions about the two most popular methods, binomial or Black-Scholes model. Binomial models is commonly used for American options, breaking down the time to expiration into several steps, then predicts the stock price possibilities at each interval based on the stock volatility and the time to expiration. So the option price is derived from the stock price by deducting the old access price to the new one, then discounting it by a percentage of the risk-free interest rate. So it's assume a risk-neutral world where the investor only look at the potential gain on each investment and ignore the potential risk. So the big advantage of binomial is to calculate the accurate price at the end of each node, but may take time due to a multi-step calculation. So binomial option pricing model were developed back in 1979 as an iteration approach diagram representing different option prices based on the random stock's price movement is derived from. During the option life, binomial trees specify the option price at each node depend on the stock price. So let's say there are two possible outcomes at each node, either moving up or down as a certain percentage. So we can generalize the calculation by consider a portfolio with a stock price S0 and an option of the same stock with the price F. So during the option lifetime T, the stock can either moving up to S0U or moving down to S0D, and the option price will be FU and FD equivalently. So we have the one step of the portfolio will be P FU plus 1 subtract to P FD, and then we discount the portfolio at the interested uh, risk-free rate, where P equal E exponent RT subtract to D, and then divide by the difference between U and D. Let's look at Facebook with the current price 191, and we try to look for its volatility. Normally, people usually compute its volatility by getting the standard deviation of the daily average return. Since the beginning of this year, Facebook have a standard deviation of 2.11%, moving around a mean of 0.5%, which is moderately high comparing to an index fund like SP 500. Then we can annualize it by multiplying by a square root of 250, which is the average trading day of the year, and it gives us an annual volatility around 33%. So the technology sector got really hard at the end of last year. So the price at the beginning of this year were really low, and the stock already picked up over 41% year to date. Even it was only just the first quarter. So I will double check by using the data seen last year, 2018. So I feel more comfortable with using still standard deviation, which is around 23% for the annual return, which give the stock movement range around 132 to 211 within the min and max of 126 and 216. Then we can build a model to estimate Facebook option price by the five main variable of the access, um, the risk-free rate, the exercise price, the current price, the time to maturity, and the volatility. We can see that the stock price is calculated forward in time, while the option price is backwards from the expiration date to the beginning, which is called backward induction. And we can see that the current price doesn't make sense with the estimated stock movement due to a slump in the market at the end of last year. Therefore, we change it back to the previous volatility of 33% that we have discussed before. Now we can compare the result with a value of a call option for Facebook in Merrill Lynch that's set to expire in December with the strike price of 155. So Merrill Lynch showed a value of 1074, which somewhat close to the binomial result of 13.08. Binomial models give a more detailed diagram by allowing multi-period views of the underlying asset price and the price under option for multiple periods, as well as the range of the possible result for each period, which called the discrete time approximation. It's also more intuitive and easier to use by adjusting the inputs to match the trader projections, or at least give them an idea where the range should be. Binomial option pricing is a relative simple to build comparing to a stochastic differential equation, but it also has some disadvantages. We can also see that binomial models still have the biggest challenge in predicting the future stock price, which means we need to continuously adjust the five major inputs, especially the volatility, to fit our stock price projection. The model may bring in some challenge in high-level precision to predict the payout at the end of each period when the number of steps increase due to exact pricing at the end of each node. Binomial trees is often used to price American put option due to no closed form solution, and we can see in the example above. Now we can look at Black-Scholes model, which also known as Black-Scholes-Merton model, were discovered in early 1970 to price European option and has a big influence in the option pricing market. And they end up even won the Nobel Prize in 1997. So it says that the stock follow a log normal distribution because the asset price can be negative, which known as the Gaussian distribution, and the stock can move with a constant volatility and risk-free rate in an efficient and liquid market. Only the volatility matter, no risk rate. And we say that the Black-Scholes is low enough for American option because there are usually no reason to exercise early. Early exercise would usually be caused by we're mispricing due to technical or market reason where the theoretical option value are messed up, so you can exercise the option right way, but this is just some unusual occasion. Now look at the formula and they can see the five variable, which is the option price volatility, time value of money, strike price, time to expiration. Um, so the option price is calculated by multiply the price by the change in the call premium in relates to the change in underlying price, then subtract to the current value of paying the exercise price upon expiration. So we can calculate the one by the absolute log row difference between the strike price and the stock price plus R plus a sigma square divided by 2 times T and divide by standard deviation multiply with square root of T. In a similar way, we can calculate the two There's another interpretation of this model, we can see below. After building the model, we can compare with the book example to get the same result of a call price 4.76 and the put price of 0.81. So the stock price need to rise to 44.76 to get even in call option, or drop to 39.19 to get even in a put option. And now we can compare it with the binomial model that we had before. And now we can see that the result from the Black-Scholes model, which is very close to the binomial model or the actual price on Merrill Lynch. We can obtain a close result through Monte Carlos by using cumulative inverse function and random to give us a random number generated from a standard normal distribution. We can examine the general properties of a Black-Scholes model when the value go extremely high. So when the stock price becomes so high that a call option is suddenly exercised, the option price will react like a forward contract, being priced as S0 subtract to the current value of the strike price, because both D1 and D2 are large enough that make their cumulative distribution go to 1. Or when sigma is getting close to 0, which means riskless assets, D1 and D2 will go to infinity, and their cumulative distribution will go to 0, which give call option price the max of S0 subtract to car time E exponent negative RT or 0. The main advantage of BSM is speed, which lets you calculate a large number of option prices in a very short time. But in reality, Black-Scholes may have too many assumptions that can be unrealistic in the certain market, such as constant volatility and risk-free rate over an option life, or an efficient and liquid market following a log normal pattern, which is a geometric Brownian motion pattern. It ignores all the large price swings, which is normal in a real world, and lead to a substantially underpricing or overpricing an option. It's also assumed that a continuous and costless trading with no trading costs or taxes. Talking about a constant volatility. So to prevent any high losses, the option trader should keep a constant watch on changing the volatility and remain prepared with a predetermined stop loss level. Understanding the option pricing model will help us a lot later for option speculation. So as long as you can assure of a high volatile market in the future, you can earn extra income by buying and selling a call, then closing out before maturity, or delta hedging to protect your stock position current value with expect a volatile market or wait until the market return to normal. But blindly following these trading models may lead to unlimited risks, like what happened during the crisis in 2008 and 2009 due to a flaw in trading model. So we should apply this model cautiously with insight about the limitation of each of them, any alternative methods, and remedial actions when the market performs the wrong way.